So, good evening, everyone. My name is Johnathan Graham. I'm from Sapphire Capital Partners. And first of all, thank you very much for having me and allowing me to present to you regarding SEIS and EIS. So, today, this is what I'll be covering, an introduction to Sapphire, what is SEIS and EIS, what are the benefits to investors, a kind of overview of the qualifying conditions companies must meet, how overseas companies can qualify for SEIS and EIS, knowledge-intensive companies, the whole application process surrounding advance assurance, and ways to raise money through SEIS and EIS. And then at the end, feel free to ask any questions. And if you have any questions throughout, I'm happy enough to have a discussion, and people can just ask away. I have no problem with that at all. So, kind of introduction to Sapphire. So Sapphire is a multi-award winning investment management and consultancy company. So we're based in London and Belfast. There are two main differentiating sides to Sapphire. You've got the consultancy side, which helps the high-risk startup companies to structure to raise investment. This is typically through venture capital tax-efficient schemes, EIS and SEIS. This includes helping them with compliance statements, advance assurance, the share structure, and writing investor documents. The other side of Sapphire is the fund management side. So we act as the FCA authorized fund manager. We currently have around 30 funds under management, which spans over various sectors and have varying levels of different investment appetites. So straight into the what is SEIS and EIS. So the Seed Enterprise Investment Scheme and the Enterprise Investment Scheme are government initiatives to support early stage startup and high risk companies raise much needed capital by offering investors attractive tax reliefs, which in turn essentially reduces their capital at risk. The intention of the schemes are to essentially encourage innovation, allowing companies who may have traditionally found it difficult to raise investment due to their kind of risky nature, raise finance much easier. It allows them to grow and develop in the long term, which is the whole ethos and in the spirit of the schemes. As you can imagine, SEIS and EIS are very attractive to UK investors. If the company qualifies, quite often investors would request it. The good thing is UK and overseas companies are able to raise money through the schemes, providing obviously they meet all the qualifying conditions. So what are some of the benefits to UK investors? One of the most commonly asked questions that we would get at Sapphire is kind of the difference between SEIS and EIS. So there are some key differences which I'll go through. The most obvious one would be the company can raise the amount you can raise through each scheme and the income tax reliefs that are available to investors. So under SEIS, companies can raise up to £150,000. So it's like the kind of seed early stage, what comes first. An investor can invest up to £100,000 and gets 50% income tax relief. Through EIS, a company can raise up to 12 million with a max of 5 million per year, and investors can invest up to 1 million per year, but they do have the opportunity to backdate this as well, so it can then go up to 2 million. Investors through EIS will receive 30% income tax relief, which is slightly lower than the SEIS, but you can raise a lot more through it, and investors can invest a lot more into EIS. Some other key details that are attractive for investors are that if the company feels loss relief is available, which on top of the income tax relief offers further reduction on the capital loss potential, which is obviously very attractive naturally for investors. There's also inheritance tax benefits as well as capital gains tax deferrals and reliefs, which all accumulates to be extremely beneficial to investors. One key point to note though is that investors must hold the shares for the qualifying period, which is 3 years from the date of issue. The company must also meet all the qualifying conditions for this 3-year period. It's very important to take that in consideration, because if you do raise money through EIS or you do go down that avenue, you definitely need to be qualifying for that 3-year period, as if the company or investor kind of breaks any conditions, the release can be clawed back, and it kind of can open up sometimes the company to issues with the investors, which naturally you wouldn't want. So it's just very important to take that there into consideration. If you're raising money through SEIS and EIS, you have to be qualifying for the 3-year period from the shares are issued. So then, an overview of the qualifying condition that the companies must meet. So this is more relative to yourselves. So raising investment through SEIS and EIS is very attractive for companies as well as investors. However, naturally, there are qualifying conditions that companies must meet, because HMRC is not going to give for nothing. So typically, the advance assurance process is the best way to get confirmation that the company is qualifying. And most investors will request that if you go to investors and say, look, I've EIS and SEIS eligible, they probably ask to request to see the certificate of advance assurance or an email confirmation from HMRC that details that you are a qualifying company. So advance assurance is essentially an insurance policy issued by HMRC that, based upon the information that you have provided, that the company meets the qualifying conditions. And essentially, if those investors then invest into the company, that they should receive the relevant reliefs. Please know, though, that advance assurance, whilst it does hold some sort of ground, that it's not 100%. So HMRC may grant it, and if they do further investigation, once you have tried to issue the EIS shares and they find there is an unqualifying element to your company, they won't grant it. So whilst it is I haven't really come across where they have changed their mind, but it is possible that they may do this. One of the main conditions to also look at is that companies must carry out a qualifying trade for the 3-year qualifying period. A few examples of unqualifying trades are dealing in land, futures, other financial instruments, financial services, property development, hotels, nursing homes. Probably a lot of things that anyone on this call will be doing, but just making you aware of them. Now, it is in certain circumstances possible to provide services to excluded activities. So if you have technology software that would be used by accountants, that's still qualifying because you aren't carrying out that unqualifying trade. Companies must also not be controlled by another company. They would be considered a subsidiary if another company owns, say, 51% or more of the share capital. One of the newest conditions as well to take note is the risk to capital condition. Now, this condition has caused quite a lot of upset in the kind of SEIS EIS world, and has been a kind of thorn in the side of a lot of companies and advisors. And I'm not too sure if anyone in the call is aware, but film used to be very big in EIS and SEIS, and due to the introduction of this condition, essentially most film companies are not qualifying. So it is essential to take that into consideration. So through the risk to capital, there must be a significant risk to investors' capital, and measures can't be put in place to reduce this risk. So you can't turn around and say, we'll buy back these shares in 2 years or 3 years. So essentially you just have to hold them. You can't put anything in motion or in place that will reduce the risk. There has to be a high risk factor. The company also must have intentions to grow and develop over the long term. And they need to be using the SEIS and EIS monies that they raise to facilitate the growth. So the working capital, or to develop into their technology research and development, employing staff, or moving into even new geographic locations, something that's going to help develop that growth. It's also worth mentioning that the company must not be listed on a stock exchange. However, AIM, for purposes of EIS and SEIS, is qualifying. And also that the money that is raised through SEIS and EIS must be spent within 2 years. And that's important within the application process, which we'll discuss later on. There also are quite a lot of conditions that are only kind of typically relevant to certain companies. But if you are seeking to raise money through SEIS and EIS, it's definitely worth to explore all of these to see if potentially within the application that there must be things that must be addressed to HMRC. Because the worst thing is, you put together an application, you send it to HMRC, and they come back with a host of questions that you haven't anticipated. You've structured your company a certain way, and there could be some sort of qualifying issue. An example of this type of thing could be the gross asset condition. So for SEIS, you can't be over 200,000, or for EIS, it can't be over 50 million immediately before and 60 million immediately after the shares are issued. Now, that's called quite a lot of companies out, especially companies that's maybe trading about a year, and they try avail of SEIS and have gone over the £200,000 of gross assets, and HMRC come back. And I haven't advised them, but I have seen where they have clawed back investors' reliefs because they invested directly to the investor and didn't actually go through the advance assurance process, which, as I alluded earlier, is very important to do so. So to qualify for SEIS, companies cannot be trading longer than 2 years, and for EIS, it's 7. Now, you have to bear in mind this is trading, not incorporation. So if you've incorporated and lay dormant for 5 years and then start trading, then you could still, avail of SEIS and or EIS. So HMRC it's quite difficult to determine how they interpret trading, but typically what from our understanding, it's the act of trying to make a sale. So it doesn't necessarily mean that you have to have made a sale. So for example, if you put a post up on Facebook of trying to sell, for example, I sell pens and I try to sell a pen on Facebook, I tried to make a sale. My product may not be good enough to sell, but I've tried to make it, therefore I've started commenced trading. So it's important to take that into consideration. And again, that has caught people out. Just probably don't want to go off too much in a tangent, but an example of this, and this actually happened, was this gentleman. We didn't advise him, but we heard about it. Basically, was developing this product in Beijing, and he set up a few posters around bus shelters and was promoting his product, and then realized that the market wasn't there yet. He would carry out more research and development, but what he had done was take a picture of the bus stops and put it on his Facebook account. Fast forward 5 years time, fast forward 7 years time, and he tried to avail of advance assurance, and HMRC had essentially gone through all the social media, gone through everything, and identified that he had done the act of trying to make a sale by advertising his product on a bus shelter. Therefore, he was outside the age requirements and did not give him advance assurance, and he could not raise money through SEIS or EIS or SEIS. So it's important to bear that in mind. So this is a slide. I think it's just relevant to one person on this call, but I'll go over it quite quickly. But more than happy to have further calls regarding this. I've helped multiple Irish companies and companies from all over the world raise SEIS and EIS. So in short, the answer for overseas companies is yes, they can avail of these schemes. However, they must naturally meet all the conditions of SEIS and EIS, and also the kind of most relevant condition to an overseas company is the permanent establishment in the UK condition. So this is a place of business in which a significant element of the company's operations are conducted from. So, and they carry out this business on a regular basis. For example, management, marketing, research and development. There's no definition of a significant element of a business, but it's kind of using the common sense a bit. So if you are, let's say, a technology company and you're conducting research and development in the UK, that's obviously going to be naturally significant. But if you have someone that's receiving, I don't know, Amazon parcels, or someone that's just forwarding letters, that's not significant to the business trade. Therefore, that most likely would not be qualifying. So a company can also meet this condition via a UK representative. So this is like a UK agent. So this UK agent would then act on behalf of the company on a regular basis. They must have the ability to enter into significant contracts and do so on a regular basis. So again, no definition of regular basis or significant contract, but it could be, for example, let's say an NDA or something with a supplier, rather than signing for, I'll use the example of an Amazon parcel again, something that is significant to the company's trade. So in addition to the above condition, overseas companies must also have a unique tax reference number and a company registration number. So it's UTR number and CRN number. The way in which you obtain both of these is to complete a UK branch application via an OSIN01 form, which is through Companies House. A UK branch is essentially an extension of the existing entity. So if you have an Irish company, it's an extension of that Irish company, and it isn't a new entity. So it's not a newly incorporated company within the UK. So that's the kind of two main ones that are applicable to overseas companies. Then the rest of the conditions on top of that, they almost qualify for that as well. So HMRC do like to see overseas companies come in, and whilst the applications might take slightly longer as you have to open the branch, there a lot of them are getting through. So if there is an Irish company who wants to operate and raise money in the UK, it's definitely worthwhile investigating into SEIS and EIS. So this may not be applicable to anyone here just yet, but in the future there may be something. So there are certain companies that need to raise investment to run or to fund research, development, and innovation, but they are outside the normal age requirements or need to raise more money than the usual scheme limits allow. So then this is where knowledge intensive companies come into play. These companies can apply as knowledge intensive, so it's KIC is known as, which have more flexibility than, say, a regular EIS company. The main differences applying as a KIC company is that they can raise up to 20 million instead of 12. So this is 10 million per year rather than the 5 million per year. And they can also raise an investment within 10 years of the first commercial sale. And if you can remember, if you go back to the normal one is 7 years. So this is only for EIS, by the way, just sorry if I didn't make that clear. They're also allowed to have a maximum of 500 employees, which is slightly different to the 250 under a normal EIS condition. If anyone's interested in finding out more about knowledge intensive companies, feel free to contact me, after the call or any time. It's a lot more complicated application process, probably I would say the most complicated, I think, when it comes to EIS. There's another type of application that's probably just slightly tops it, but the knowledge intensive, you have to have a certain number of people with a certain level of degree working on your product, a certain amount of research and development, 10% of overall turnover, etc. So, but if anyone is interested in that, please just contact me and happy to discuss that. I thought I'd add some statistics into here just so you can get a kind of an idea of how many companies and how much is being raised through SEIS and EIS. So 2 billion was raised through EIS in 2017-18, and this covered 4,130 companies. I think in 2017-18, Sapphire had maybe done about 200. So you can imagine, and we are one of, we do quite a lot of companies. So you can imagine how many companies are going down that route. 20 billion has been raised through EIS since its corporation in 1994. It's helped almost 30,000 companies, which is, and some of the companies that have utilized EIS and they're doing so well at the moment and have even exited or got their IPOs, and there's some really good companies out there. Under SEIS, it's slightly smaller, as you can expect, because the max you can raise is 150,000. So 189 million has been raised through SEIS, and that's again in the 2017-18. And 2,320 companies have associated with that. Now, these statistics are from 2017-18. Unfortunately, I think it was only last week the new updates were out, but they didn't give you how much was raised in that thing. So probably in the next couple of weeks, we will see more statistics coming out from the EISA, which is the EIS Association. But apologies that I've got you kind of statistics from a couple of years ago, but they are the most up to date. So 1 billion has been raised through SEIS since 2012, which is only really 8 years, and that's quite a lot, especially if you take into consideration the 150,000 maximum. So this is probably a really important page. This is the application process for advance assurance. So as detailed earlier, the advance assurance process, I would always recommend it. HMRC always recommend it as well, especially if you write to them and inquire about EIS. They say, we advise that you go down to advance assurance and we'll be able to give you a better understanding if you are qualifying, or if there's any questions that we need to ask, then we will do that. So, and it's also, is often requested by investors, because if an investor puts their money into your company, they have to pay for the shares up front in full and then issue the shares. So if they pay up front and the company starts spending, and then 6 months down the line, they go, okay, we're going to fill out the compliance forms and get your tax reliefs. And then HMRC are like, hold on a second, we don't think you're qualifying, so we can't grant the investor his tax reliefs. The company's already started to spend the money, doesn't have any other money in the bank to pay back the investor. The investor isn't getting his reliefs, and then naturally he isn't very happy. So advance assurance is always very important. The application process for advance assurance typically takes 3 to 5 days to draft, if from our perspective at Sapphire. And once submitted to HMRC, they aim to respond within 45 days. Sometimes they may need more information to make an informed decision, or they may not understand something, so they come back with questions, which can further delay it a little bit. very, very rarely have I ever seen it go to the 45 days. You often see it a couple of weeks, 2 to 3 weeks now. We're seeing applications come back. We had one back a couple of weeks ago within 3 days, but HMRC do have a disclaimer on the response email saying that this could take up to 45 days. So within the application, HMRC requires an up-to-date business plan. This will detail the fundamentals of the company, the trade they've undertaken, their plan they undertake, the share structure, the size of their market they're looking to operate in, the products or services, the management team, financial overview, the detailing, just the whole different element of the company. They want to have a look at it to see if it does meet the ethos, if it's a proper company for EIS purposes, and also if it meets the conditions. HMRC also require the most relevant up-to-date accounts and 2-year financial projections. So these financial projections need to be shown monthly. They should demonstrate that the money being spent within a 2-year qualifying period. So if you can remember back to one of the qualifying conditions, that the money raised through SEIS or EIS must be spent within 2 years. So within the financial projections, you must demonstrate the need for investments, and then, as I said there, it being spent. So to basically do that is the way to do that is to show the money coming in, and then have your closing cash flow, or your bank balance. In some circumstances, depends what you label it, going to zero or negative. Now, from a logical perspective, that sounds quite strange. If you think to yourself, why would you want to demonstrate in projections that the company could have no money in the bank? Because this could be seen as financial difficulty, or this could be seen as, if the bill comes in, they can't, pay it. But it basically shows HMRC that you have used all that money for what you're intending to use it for. So if you had, let's say, £1 million coming in, and the lowest that your bank balance went was £200,000, they would say, we think that you only need £800,000 because you have £200,000 in the bank that you could use as well to reinvest that into your company and help you facilitate growth and development. So that's essentially what you need to be kind of wary of, is to show that the money's being spent and all the conditions to that are met. So within our applications, especially myself, I like to include a cover letter. This cover letter usually varies in length, but typically say 8 to 10 pages. I essentially detail every element of the company and how it meets the conditions. So I'll say, as previously mentioned, the gross assets, the employees, the share structure, cap tables, absolutely everything. I do this because I don't want HMRC to come back with any questions. I want to make this a quick process and just essentially detail them, show them everything. It's always better to be completely transparent with HMRC, because they will find out, whether it's in 6 months' time or 5 years' time. They typically, kind of come across something, and if they're not happy, they will call back reliefs. I actually was talking to another advisor who was telling me about one of his clients many years ago, who essentially, they didn't disclose all the information, and they had a technology software for insurance companies, but they were also underwriting as well within that they're offering, but they didn't disclose this to HMRC. And what had happened is they essentially raised 3 rounds of finance through EIS, and that was all fine. Investors got their release, everything's fine. Fast forward 5 years time, HMRC done a VAT inspection into them, and essentially the VAT office have requested information from the department that deals with EIS and SEIS, and sent over information, and they looked at it and was like, wait a second, this is different to what we've seen. They don't qualify, and they clawed back relief that far ahead. So they are able to do that there. I think that would be quite harsh if that ever happened. And that ended up going to court as well. So yeah, that's an important element as well. So as well, depending on the company's trade or operation, additional supporting documents may also be required as part of the VAT assurance. So this could be details of any IP. So if you, for example, licensing is technically an excluded activity, but without getting overly complicated, if you develop the IP and you're licensing that IP and it's treated under the conditions of IS 10 under the accountancy standards, then this could be qualifying. It is kind of up to a lot of interpretation. I have only kind of came across it 2 or 3 times, but within these circumstances, a lot of supporting documents would need to be provided to HMRC for them to make an informed decision. Same with any agreements with certain suppliers. Sometimes, so like a kind of strategic partnership typically isn't qualifying under EIS. It really does depend on what the kind of parameters of the strategic partnership. For example, if I know myself and Michael have 2 separate companies and our trade is, we have 50% each in a trade, that's shared risk. So my investors are only sharing part of the risk. Therefore, if you can remember back to the risk of capital, that potentially will not be met through that there. Same with any agreements such as shareholders agreement, subscription agreement, they must also be provided to HMRC. The reason for this is essentially down to EIS and SEIS shares must be ordinary shares with no preferential rights. So therefore, they want to check the shareholders agreement to ensure there's no preferential rights in there, or there's nothing that reduces the risk of investors, and they want to read through that there. So what we typically do is send it to HMRC in draft form. So if you send it in draft form and they come back and say, sorry, this isn't qualifying, just be like, oh, sorry, this is a draft, so we will amend that. We were meant to do that. So that's just one of the ways around it. We also would recommend submitting a draft director's resolution, again, draft form. So the director's resolution basically states that all shares are ordinary shares with no preferential rights. We used to get this question back all the time, asking us to prove how we could demonstrate that the shares were ordinary shares with no preferential rights. So what we've done is created this document, and we've never had that question again. So it just kind of eliminates that. But if anyone has any questions in this, typically there is quite a lot. Also, there's an online form and a checklist that must be completed. It is quite a rigorous process, and it is important. There's no real room for margin for error, as HMRC will come back. They will ask questions, and if they kind of get spooked first time around, it's quite difficult to change their mind. So different ways to raise money through SEIS and EIS. I'm sure you've been told this plenty of times. So there's obviously very different ways in which you can reach relevant SEIS and EIS investors. But I would advise make sure you have plenty of information to supply to them, including it does really depend on the type of investor. But from our fund perspective, we want to see teaser documents, business plans, and obviously where relevant, depending on the size of the company, information memorandums. Now, if you haven't traded before, very small, and you're trying to do a small round, doesn't make sense maybe to have one of these, or potentially it does, depending on your type of company. The investor fund also may want to find out certain specifics, for example, how you valued your company. So I would be ready for this type of question. If it was me, and my type of question that I would ask people is, I like to break down the projections, the financials. I really wholeheartedly focus on them. If they have a figure sitting there and it doesn't really sit well with me, I'll break that down and ask the questions surrounding it and expect them to be able to hopefully answer that there. And if they don't, or if they, for example, let's say, you projected that you're going to have an increased revenue of 83% from year 1 to year 2, how do you justify this? And they can't actually justify it and can't give me a good answer. I will say, well, if you kind of don't know that, then how valid is the rest of the information that you've provided? So it is very important to really understand everything you have. So if it's internal rate of returns, if it's your valuation, just know how it got there. How if you did basically get engaged with another company or advisor company, consultants to value your company, or you've done it yourself, just make sure you understand that element, because that's what I would ask on. And I'm sure a lot of investors, especially if you go to funds, that's what they would probably break it down a lot themselves, but also ask you the question how you got it. Angel investors are very common when it comes to EIS and SEIS. Sometimes they like to invest in syndicates, sometimes alone, and sometimes as a lead investor. You also may find, if you're fortunate, an angel investor who has experience in your sector. And so therefore you may find that they are able to add value in addition to providing capital, which is obviously, if you're an early stage startup company that's maybe not traded very long, or say the entrepreneur is an engineer that maybe doesn't understand business as much. If you have an investor who does, bringing them on board to help with that there is obviously invaluable and could definitely help add to the success and potential of the company. Another option is SEIS and EIS funds. Quite often funds have specific investment criteria, but it's definitely worth looking into, reaching out. We, as I said, we have 30 funds under management. We have varying levels of different stages of companies. We have SEIS funds that are obviously sometimes pre-revenue. We have a British robotics one that focuses on SEIS early stage companies. We have funds like a Fuel Ventures fund that are follow-on funds, so they like maybe even up to Series A. And their investment appetites or sector options is typically towards platforms. They love platforms. So at the moment, all they're investing in seems to be platforms. We also have, I'm sure most people's heard of Creative England. So we have a fund with Creative England. We have a fund at the minute, Zero Carbon Fund, which is like an eco-friendly green fund, it's fantastic. And I actually didn't realize how detrimental the environment the businesses actually are. Obviously, I know about global warming and stuff. So from reading that that's a really good fund, and they obviously naturally only invest in companies that are environmentally friendly. We also have a fund that the gentleman that leads that there, he essentially started a company from scratch in Australia, and it got $1 billion valuation in the NASDAQ, which is fantastic to obviously get from. And honestly, he started up by himself in his front room. So also another option then is crowdfunding is a useful method of raising finance. Michael will be able to do this more justice than I ever would, so I'll not go into too much detail on that there, but all options are definitely worth investigating, and some options suit different companies better, especially if you are at the very early stages. It might suit to go to an angel investor. I don't know your company, so I'm not advising, I'm just saying there is multiple options that is available there. So that's the kind of end. Hopefully that wasn't too brief, and it did give you a good overview of the kind of SEIS and EIS schemes. As I said before as well, there is 2 other schemes. So there's this SETR, which is more towards like kind of social investment. So it's for community interest companies, and companies that are more towards the community, charities, things similar to that. And then there's VCTs, which is a completely different ballgame and a completely different presentation. So thank you very much for your time, and I'll definitely welcome any questions. And my details are here on this slide. If anyone wants to ask any questions or needs any introductions to anyone or anything at all, please feel free. And I'm happy to send this presentation if anyone wants it for notes or anything like that. So yeah, thank you very much.
Brilliant. Thank you, Jonathan. That was really useful, and some good insights, both from kind of the startup point of view and the founder viewpoint of what startups should be doing, and then also from the investor point of view, what should they be asking for in terms of the advance assurance and trying to get that.
Yeah.
Quite often you see companies say they're investor ready or EIS ready, but to get that advance assurance is probably quite key.
Yeah, it's definitely the most, what I would say was, if I was advising anyone, it was the first thing to do is get advance assurance. It's just so key. Even if I've had companies who are maybe not at the stage where they need to raise finance, but they are able to apply for advance assurance. Then when they are, there's no delay. They don't have to wait 6 to 8, 12 weeks. Sometimes if there are questions from HMRC to get advance assurance, they already have it sitting there. They know exactly what they're looking to do as from a business perspective, so they can put it into an application. So it's definitely worthwhile if a company does envisage it needs to raise capital, and most companies do. So it is very, very interesting.
There's a question here. You'd mentioned a carbon or sustainability fund.
Yes.
Is there any information on that?
Yeah, I can provide more information on that there. Someone, if they want to see the investor synopsis or anything like that there, or they can see the information memorandum, more than happy to send that over to anyone who's interested. Just reach out to me. But that fund is very good. It's only they're only in the raising money stage. So I think it's a lady called Pippa Gawley, lovely lady. I actually work directly with that fund. I'm kind of doing their applications at the moment for investors coming on board. So I think they've raised it's quite a small fund initially for the first one. So they're on about 1.2 million, I think. So they'll probably do quite small tranches of investment, 100,000, 250 type of range. It will really depend on the company. But if anyone is interested in that, please feel free to reach out to me, and I can have a discussion, introduce you directly to Pippa. We also, sorry, we also have on our website, we've just only finished it on Friday there, where you can basically access and apply to any of our funds on our website. So you don't actually have to go into our funds website, or don't have to contact anyone. You can just complete a form, submit the relevant associated documentation, and then you're ready to go, and it's applied straight into the fund. So there's multiple options there. That's on our website then. So it is for company, under the company section. So it might be worthwhile looking for some people.
You know, I suppose from the startup side of things, you're obviously looking for a good team, you know, a solution that really solves a problem. And are you looking for traction as well, even down at that kind of EIS stage? Do you still look for some sales and traction?
Well, it really sometimes.
EIS fund?
Yeah, well, for EIS, that most often, yes. For SEIS, which is the seed, you do have a lot of pre-revenue, a lot of research. It really depends on the company and the fund. If you have a company like the British Robotics, I done 60 diligence for them just for the tax year, and not one of them where have any traction or any customers made any sales. And I think they've been going for all of them over 3 years, so all research and development, and they're in multiple stages of funding. So therefore, those type of companies won't. If it's an EIS company, it's been going, you know, it really depends, again, as I said, on the appetite of the fund. That few ventures I mentioned, yeah, they all have to have traction. They probably have to be maybe, you know, just nearly Series A round. It's way follow on. A lot of companies that potentially here might not be suitable for them. So it really just depends on the fund and the company and what type of company it is. But I think one of the most important things I do look for, apart from, I'll get into the financial side of things, but apart from that, there is the management team. If you have someone that has experience in that area, and you have a management team that has varying levels of experience in, say, business and marketing, in research and development, in technology, then you have a really good skill set there that's able to add to the company and help potentially for it to grow and develop. So if I make that investment, there's a good management team I trust there. Trust is a key element. You have to, obviously, a lot of our funds would go out directly. Obviously, it's quite difficult at the moment with all the lockdown measures, but we would like to go out, you know, we meet with the companies, do meet with their management team, see what they're like themselves, and quite often that is where the decision making comes into play. But obviously they have to get the attention of the funds as well. And I kind of alluded on it slightly within that presentation, but financials for me are one of the most important things. And actually within any business, you know, the kind of money side of things makes it tick. So the more information the company or a fund or investor has, then they can make, you know, a more informed decision. There's plenty of times where I'm getting a sheet of paper that's basically just a few numbers on it, and I'm like, you know what, I don't know what that is, you know, as in I can't make a decision based on, you know, 6 months projections with, you know, a couple of lines, and it's, or 1 year projections only shown annually, it's just year 1 or year 2. I can't really break that down and say it. So it's important to provide the investor or the fund with as much, you know, information, relevant information as well. You don't want to give them a lot of information they won't be able to use. But if it, more for myself, you know, if it's a company that's maybe hasn't got much trading history, then the financial projections comes into play. Now, I'm more than aware that financial projections aren't bulletproof, and quite often a lot of people start off with picking a wee number from the sky and just working from there, and kind of, but it's more, how do you justify it? So if, let's say in physics that you're able to get 100 customers in month 1, and then multiply that there by, you know, 2 to 200, 300, and then you're able to accumulate that there in your revenues, and then you have to have more staff to facilitate that, and you can justify that to me, and I'm like, okay, that sounds good, right? That makes sense. Then that'll add up. If this is the course of action that goes down, then this could be quite accurate. But if they turn around and say, I'm not too sure, we just kind of put a number down there because it's just projections and we can't really predict the future, then I'm like, well, how am I meant to invest in your company if you don't even know what you're doing, type of thing. So it's important to understand from that perspective. So yeah, that answers your question, hopefully.
Yeah. From the other side of the coin here, we had another from the investor side, what's the appetite? Have you seen much appetite? I mean, obviously you mentioned the funds, if they're fully subscribed, they'll be maybe out looking for opportunities. And separate to that, the angel side, if you have any insight to funds versus angels appetite.
Really, for the early stages, angel investors do like the kind of early stage. Obviously, funds do have certain appetites for early stage as well, but you do see a lot of the kind of SEIS and early stage EIS are made up of the angel investors. Quite often, I would have companies come to me who have raised EIS before, who maybe do knowledge intensive, or who want introductions, and their cap tables are filled with individuals and not the funds.
Yeah.
So I would say, from my experience and what I see, the kind of early stages of funding is from the angel side of things. And I'm not saying all funds are like this, but certain funds may want more equity than an angel will, and they have certain conditions. And especially if you start getting into venture capital, then it's a whole different ball game. So it's just more. I think reaching out to the angels, there is platforms out there, and there's introductions people can make, stuff that can help you with that there. I think there's quite a few that we have kind of relationships with. So if anyone is looking to meet up, there's a platform called Swoop, if anyone's ever heard of it, Angel Investment Network. They're all different networks that people can just go on, upload your business plan, your pitch deck, things like that there, and then you're able to reach out directly to investors. Swoop's quite good as well because they are able to help you with grants and loans and things like for government, as well as introduce you directly to investors, to funds, things like that there. They're able as well. There's a company that I was dealing with, and they had litigation issues with IP infringement from a large company in which they couldn't really go against them. So Swoop introduced them to a fund that specializes in this. So they pay up front all the legal fees to take equity. And as far as I'm aware, I think they were quite successful, and they were able to come to an agreement with that company, and that fund is just basically got equity for fronting a bit of legal costs. So yeah, Swoop is a great opportunity out there. So it's definitely, I think it's worth looking at all options and seeing where the kind of the bite is. And the more that an entrepreneur or company gets out there and pitches and learns and sees what the type of questions that come up or the type of people that are interested, quite often you might see that, okay, angels aren't the type of people that we want to go for here. We want to just go in, get a fund that maybe is going to upfront 50% of how much we're looking to raise, and then angels or crowdfunding can make up the rest.
And how do you think things will sort of pan out for the investor world, maybe coming out of lockdown, dare we say?
Well, that's a very difficult question. That's kind of like a financial projection question. It's like trying to predict the future. It's one where this is my own personal opinion now. This isn't really an educated opinion or anything, but it's just from what I've seen, is that people seem to still have money. It's not that they've lost money. So I have a client who has a huge company in the US. He's actually from Northern Ireland originally, from the Mavati, but he moved out to the US 30 years ago. He's done a lot of property funds with us. And he says in 2008, after 3 weeks, he lost over 70% of his client base. And he said within 3 weeks here, he's gained 10% off the COVID thing. So people have the money, the business are still operating. I reckon once uncertainty has been lifted, no one's going to really invest, or there might be put off investing slightly whilst there is a cloud over where they don't know what's going to happen. You don't really want to just put your money in something you don't. It's almost like a gamble. So I think once that's lifted, obviously I'm not going to say it's going to go back to normal, but I think it's going to be a lot quicker than something that happened like 2008. Now that's just my personal opinion, and from talking with people, talking with a lot of investors. As I said, for that zero carbon fund, I'm doing applications for people putting in hundreds of thousands of pounds into this fund now, and that was last week.
And that's the fund only just opened.
That's a fund only just opened, and I'm still doing compliance forms for companies. So once you obviously have advance assurance, but once the company raises the money, so investors put the money into the company, they issue the shares, you then complete a compliance form, so EIS1 or SEIS1 form, and then the investors essentially give their release down that way. So I'm still doing those forums, so people are still investing, so they're not stopped. It just, I think maybe the momentum has kind of reduced slightly, but hopefully, fingers crossed, once this kind of lockdown is lifted and people go back to some sort of normal life, then the money starts to come out of the bank account, they're under the mattress, and people start investing back in the companies like they did just pre-COVID, hopefully.
Yeah. Has anybody else got any other questions? Do you want to pop them here in the chat or shout them out?
All answered up. That's a good sign.
Yeah, and no, it was really useful. It kind of just, it proves it's one of those jobs that's well worth doing, and from a startup point of view, it just takes a bit of time and energy and getting everything and giving all the ducks in a row, I suppose.
And is it fair, Jonathan, to say is Northern Ireland still get the lowest uptake of EIS of anywhere in the UK, and it has to be encouraged?
Most definitely, yeah. So we're obviously Belfast and London based, and I would say of all the clients that I have done, say 1, 2, 3% are probably from Northern Ireland. Vast majority are London. I've got more in Scotland, Wales than ever in Northern Ireland. I've actually got the same amount from Jersey than I have in Northern Ireland. So it just shows that and we obviously go to a lot of events. We host the EISA conference every year, and it just obviously there's a lot of companies that benefited from EIS in Northern Ireland, and it just seems that some people are maybe not fully aware of it. Companies in Northern Ireland, or maybe they're just unsure. Sometimes people think it's too good to be true, and I often do think that as well. Is that, you think about it from an investor's perspective, they're getting 50% income tax relief. That sounds fantastic. Is this some people do have the mind of this must be a scam, or this must be tax evasion or something along those lines, where it's not. It's completely legit on the government website. But yeah, most definitely Northern Ireland it is increasing. We are getting inquiries. I had a phone call the other day from a gentleman in Belfast who's looking to raise some money, and a couple of weeks ago as well. So it is increasing, and hopefully it continues to do so.
Good.
In terms of kind of the EIS process, obviously Sapphire Capital do this as a kind of a agency type. Is there a fee model or plan model? Do you do EIS kind of preparation, and then do you do anything around kind of the investor matching piece, or is it just the EIS sort of preparation?
Yes, so that would be applicable to a kind of startup company. Yeah, we don't actually raise money for them. We feel that that's a completely different skill set that someone needs to be completely focused on to offer that effectively. So what we do is kind of the investment ready stage. So that's the kind of consultancy side, advisory side of Sapphire. So that is the advance assurance process, the compliance statements, investor documents, things like that is where we would hold that side, rather than obviously the other side then is we are able to assist in setting up funds as well, but in terms of raising money. But when it comes to that, when it comes to R&D tax credits and things, or legal advice, I'm able to make introductions on that. We're more than happy to help any way we can, more than happy to point in the right direction or give any of our experience related advice to that there as well. We don't just set up for advance assurance and then say goodbye and that's the end of it. We try to help as much as possible. So if anyone ever has any questions, please just reach out to me at any time, and I'm more than happy to help.
Yep, no, that's really helpful. Thank you.
No problem at all.
Check and see if any other questions coming through here. I suppose there's the contact details are there. Maybe if there's any further questions, the guys can get in touch directly with you.
Or LinkedIn as well. I have LinkedIn there. More than happy to connect with it. Hopefully connect with everyone on LinkedIn, but if anyone wants to just reach out there, please do. And hopefully get a grab a coffee or a beer after this lockdown's lifted as well. I'll hopefully come down to one of your events and see everyone as well.
Brilliant. That would be great. Really appreciate it. Thanks for this, John.
No problem at all. Anytime. Just let me know. I'm happy. No problem at all.
Look after yourselves, everybody. And
Yes.
if you want to share the deck with me, and if anybody wants to drop me an email, I can share it with them. Because I don't think all the details are here on the call. And yeah, your contact details are there as well. I can share those with everybody in terms of your email address and phone number. They're all on your website as well. So
Yeah, and they can have the presentation if you wanted for any, just if anyone wants to kind of learn different elements of it, or maybe I spoke too fast, just let me know and I'll send it to you.
great. Super.
Perfect.
Great.
Thank you, everyone.
Thank you for your time.
Thank you all. Cheers. Thanks. Bye.
Cheers. See you later. Good night. Bye.
Yeah, you too.
Bye.